Welcome to PhillipCapital's Weekly Market Watch. We have seen 1 month of trading in markets, how has it performed, and where it is likely to go for the rest of the year. Let's hear from Mr. James Chua, investment analyst from PhillipCapital Management. So James, what are you seeing in terms of equity markets so far in 2009?
Yeah, in 2009 so far we've seen flat to lower prices on most broad equity indexes. China is up about 26% because of the infrastructure stimulus plan that's been articulated by the Chinese government. By and large, the bulls didn't get what they wanted to see in terms of an equity rally during the first quarter. Well, in terms of what the price is telling us is that investors certainly don't have much to go by in terms of being bullishly confident. So just from a price angle, you would say the market is still telling you to be cautious going forward.
What are the bright spots for equity markets in 2009?
The fundamental bright spots are things with respect to the infrastructure theme, themes with respect to the distress theme, except investors would probably have to wait longer than they expect for the markets to recognize that mispricing. What we've seen during the course of 2009 is that the correlation between different equity market segments have really been rising. One example is, if we look at emerging market equities versus developed market equities, they persist in behaving very similarly. If we look at the behavior between the prices of small caps versus large caps, they also persist in having very similar sorts of behaviors. So we don't expect that investors are going to get much return differentiation from specific areas of the equity market. Much of that differentiation is going to come as a result of allocations into different asset classes such as bonds, fixed incomes, treasury bills.
What is the earnings outlook like?
Yeah, in 2008 for US earnings, companies are expected to report 33% decline in earnings. For 2009, we expect earnings in the US to be flat to down. By and large, we've seen about 60% of US corporates report their earnings as of last week. And what we've been seeing as a central theme across the board is that there's great uncertainty with respect to management. When prompted, management do not want to give forward guidance because of low visibility of earnings going forward, low visibility of the economic outlook. So we think it's a very low visibility environment. It's an uncertain environment, we wouldn't be plunging head to a cyclical type of companies in this sort of uncertainty right now.
In view of low earnings visibility going forward, how are you going to position the client portfolios for 2009?
Yeah, in 2009, we think that differentiated performance comes from the portfolio manager's decision to allocate into bonds. As I mentioned earlier, we're not going to get much differentiated performance as a result of buying different types of equities. One would get that differentiation from his allocation or her allocation into bonds, high-grade corporates, or government type of bonds. So what we've been positioning for investors is we've been looking at a lot of the high-grade corporates. Some of them trade north of 15–20% on the coupon. A lot of these bonds are trading below par because of the lack of liquidity in the bond market and the general trend towards deleveraging, that is to hold cash above every other asset class. We think some of these bonds are mispriced, and in a normalized economic environment, we expect the pricing to return to normal again. So we think the area to focus on from a portfolio standpoint is really the area of bonds, corporate bonds, but stick to the high grade, above single and double A type of bonds going forward.
Thank you, James, for your time today. With that, we come to the end of this week's Market Watch. Tune in next week for more market updates.